In this video, we'll take a close look at the most recent developments from Tesla, including their groundbreaking residual solar and battery storage solutions and their ambitious plans for humanoid robots. So grab your popcorn because we're about to delve deep into the latest developments from Tesla. Before anything else, be sure to like this video as we explore the electrifying world of Tesla and the future of sustainable transportation. Also subscribe for only pay. In an unexpected turn of events, the company stated that it would not allow its automotive division's gross margin to drop below 20%. However, reality set in when they failed to meet this target in the first quarter alone. The magnitude of the situation became a major concern after Tesla assured investors that they would maintain this margin throughout the year, but with recent price cuts, the margin is expected to decline even further. Some people think that lower commodity costs would mitigate the price impact. But Tesla's results contradicted this. They not only underperformed their guidance but also fell short of market expectations, which caused the stock to decline and make investors wary of making any rash decisions. Taking a look at Tesla, it's important to take into account the opinions of top stock expert Dave Ives, who shared insightful information that could influence one's decision-making process. It seems like the situation requires more than just a cappuccino to be handled effectively, and Tesla has been going through a difficult time as a result of 6 price cuts. Although the stock showed signs of recovery earlier this year, the company now needs to demonstrate sustainable growth in China. The delicate balancing act for Tesla will be navigating through the ongoing price war and achieving a gross margin in the 20 range excluding credits. While I believe the stock is oversold, it still has to prove itself in the second half of the year. Tesla's profit will need to increase in the second half of the year. However, there are a few potential bright spots to look forward to if things go well. If things go well, Tesla's stock could once again soar and possibly reach the 300 mark. The reality is that Tesla may not be as profitable this year as investors had hoped. How is the car likely to accomplish this? What conditions must exist for this to occur? Let's investigate this more. Wall Street analysts are worried about Tesla's profit margin. Although the company did raise prices in the US earlier this month, it followed a series of global price reductions at the beginning of the year. Despite this situation, investors should focus on the bigger picture. Advantage could erode due to recent price cuts. By maximizing market share and achieving economies of scale, Tesla, which has aspirations of becoming a mass-market automaker, aims to pass operational cost savings to customers. Keeping faith in the automaker may be the best course of action as Tesla has the potential to realize significant cost savings in the future. This strategy has the potential to reward investors much more than a low-volume, high-margin model. While there are uncertainties given the company's strategic direction, focus on cost savings and ambitions for market expansion, it is not completely out of the question that Tesla's stock could reach all-time highs once more. As time goes on, we'll see whether Tesla can overcome its obstacles and propel its stock to new highs. If you've noticed, there has been a noticeable decline in Tesla stock. Smart investors, however, have noticed the trend and are interested in learning more about the company's other groundbreaking technological innovations. In addition to electric vehicles, even more alluring is the current Tesla stock price, which is significantly below its market value. While some investors and analysts remain skeptical, there is still a lot of optimism surrounding Tesla's prospects. However, not everyone shares this sentiment. Recently, the stock experienced movement following a statement made about the company. Currently, Tesla stock boasts to price their earnings at around a 45 PE ratio, compared to the broader stock market's PE ratio of 19.2. Horton boldly predicted that Tesla shares would never again reach 300. He justified this claim by noting the company's price reductions for its electric vehicles, EVs, and anticipated decline in demand while simultaneously increasing production. If Horton's predictions come true, the stock's trading volume will be significantly lower than the average daily volume of 171 million shares, having fallen to 46 billion shares as a result of his bearish view on Tesla. There are a number of factors in play that could have an impact on Tesla's performance over the course of the next year, including worries about inflation. The overall economy has been severely impacted by increasing interest rates and the potential for a recession. But despite these difficulties, the automaker is benefiting from a number of positive factors. One of Tesla's distinguishing features is its profit margins, which in 2021 tend to outperform those of its industry rivals. When compared to major U.S. competitors Ford and General Motors, whose margins typically fall in the single digits, the company generated an impressive $81.5 billion in total revenue, yielding an operating income of $13.7 billion and a margin of 16.8%. There are a few important factors that contribute to Tesla's exceptional profitability. First off, the company's strong brand recognition renders costly advertising and promotion unnecessary. Additionally, Tesla's management has successfully implemented manufacturing efficiencies and vertical integration, enabling in-house battery production and direct-to-consumer sales. These business strategies have improved margins and generated significant profits for Tesla, which is a major player in the automotive industry and a pioneer in artificial intelligence-powered self-driving software. By 2024, Tesla will be well-positioned to enter the autonomous ride-hailing market thanks to this cutting-edge technology. Self-driving cars may usher in a new era of ride-hailing, potentially generating a staggering $14 trillion in value by 2027, according to early investments by ARK Invest. The demand for these products has increased in the first quarter, with battery storage capacity deployed rising by an impressive 360% compared to the previous year, further solidifying Tesla's position as an innovative force to be reckoned with. Tesla continues to make progress in the residential sector by offering solar and battery storage solutions to power homes. Tesla's capacity for production has gradually caught up with demand, enabling them to satisfy the expanding market's needs. The electric vehicle industry presents a significant opportunity, making Tesla stock an appealing long-term investment. Additionally, in 2027, Tesla plans to introduce Optimus, a humanoid robot with applications and low-skilled jobs, particularly in manufacturing. According to estimates by ARK Invest Management, as more electric vehicle manufacturers achieve scale, operating costs are expected to decrease, leading to increased sales. Global production of electric vehicles is anticipated to soar from 7.8 million units in 2022 to 60 million units in 2027, a staggering compound annual growth rate of 50%. Coincidentally, this growth rate matches Tesla's production expectations. Over time, the speed of electric vehicle charging has greatly increased. Tesla notes that while electric vehicles made up only 10% of new car sales in 2022, it now only takes 15 minutes to charge an electric vehicle for a 200-mile drive, down from around 40 minutes 4 years ago. Tesla also plans to reduce this charging time to just 4 minutes within the next 5 years. According to Goldman Sachs, the percentage may skyrocket to 61% by 2024, despite competition from unsuccessful. By concentrating on maximizing long-term market share rather than short-term profit, Tesla's strategy of maintaining low prices helps ward off potential threats. Rivals like Lucid and Rivian Automotive follow a similar strategy. Government policies in the United States and Europe, which intend to outlaw the sale of gasoline and diesel vehicles by 2035, further support Tesla's growth prospects. Tesla seeks to establish itself as a dominant player in the developing electric vehicle industry. Additionally, as gas prices rise, electric vehicles become more appealing and practical. In its most recent impact report, Tesla acknowledged its environmental impact and described the steps it has taken to address it. According to Tesla, the manufacturing of batteries and the extraction of minerals accounted for 27% of its carbon emissions in 2022. The use of aluminum and steel contributed the remaining 47% of emissions. Employees in downstream transportation and distribution who commute for work purposes and who drive Tesla vehicles. This is the first time the business has provided an accounting for, despite the fact that the supply chain for electric vehicles currently produces more emissions than that of gas-powered vehicles. Lifetime emissions from conventional vehicles are much higher than those from electric vehicles. According to Tesla calculations, conventional cars continue to burn gasoline for the duration of their 17-year lifespan, whereas electric vehicles emit 55 tons less CO2 over their lifetime. While Tesla stock still has a long way to go before reaching its previous peak of $300 per share in December, it has been making up lost ground in 2023 and could continue its upward trajectory throughout the year. Tesla plans to cut prices by 50% for its next-gen vehicles, as highlighted in its Investor Day presentation, and could support further price reductions while maintaining industry-leading profitability. What do you think about Tesla stock reaching the 300 mark? Let us know how much you value Tesla, and be sure to click the screen to watch the next video.